Before we dive in, a critical disclaimer. I am not a financial advisor and this presentation is not financial advice. The content in this video is for educational and informational purposes only. The cryptocurrency market is extremely volatile and carries a high degree of risk. You should always conduct your own thorough research and consult with a qualified financial professional before making any investment decisions. Never invest more than you are willing to lose. Alright, let's get into it. You feel like you missed it, don't you? You sat on the sidelines and watched the 2021 bull run. You heard the unbelievable stories. The college kid who turned $1,000 into $1 million on a meme coin. The early Bitcoin adopters who are now set for life. And a part of you thought, that's it. The ship has sailed. I'm too late. You're paralyzed by the fear of buying at the top, of picking the wrong project, of becoming someone else's exit liquidity. What if I told you that feeling is a lie? What if I told you that the 2021 run was just the warm-up act? The biggest, most explosive, most life-altering wealth creation event in the history of cryptocurrency hasn't happened yet. And all the data, all the cycles, and all the money points to one specific time frame, 2026. This isn't about wishful thinking. This isn't about hype or chasing the next shiny coin. This is about understanding the blueprint. Today, we are going to build a data-driven, logical framework for analyzing the crypto market outlook for 2026. We're going to cut through the noise, the fear, and the ridiculous hype to give you a clear thesis you can use to navigate the next 24 months. We're going to break down the 4 titanic forces that are converging to create what could be the most powerful crypto supercycle we have ever seen. These 4 pillars are the Bitcoin halving cycle, the unprecedented wave of institutional adoption, the coming regulatory clarity, and the technological maturation of the entire ecosystem. By the end of this analysis, you won't just have an opinion. You'll have a strategy. You'll understand the why behind the what, and you'll be positioned to see this market not with fear, but with clarity and conviction. So let's start with the engine of the entire crypto market, the foundational principle that has dictated every major bull and bear market since the beginning, the Bitcoin halving. If you only understand one thing about crypto market cycles, it has to be this. It's the heartbeat of the market. Every 4 years, or more specifically, every 210,000 blocks mined, the reward that Bitcoin miners receive for securing the network is cut in half. Think about it in the simplest terms possible: supply and demand. Imagine there's a gold mine that produces 100 gold bars a day. The world gets used to this new supply. Then, one day, a switch flips and that mine can now only produce 50 gold bars a day. And 4 years later, it drops to 25. If the demand for gold stays the same, or more importantly, if it continues to increase, what happens to the price of gold? It has to go up. Simple, powerful, programmatic economics. This isn't a theory. It's history written in price charts. Let's look at the data. The first halving was in November 2012. The market peak, the top of that cycle, arrived approximately 1 year later in late 2013. The second halving was in July 2016. The market peak, December 2017, about 17 months later, when Bitcoin famously hit nearly $20,000 and entered the mainstream consciousness. The third halving was in May 2020. The market peak, November 2021, 18 months later, when the total crypto market cap soared past $3 trillion. Do you see the pattern? A halving event occurs, which dramatically cuts the new supply of Bitcoin entering the market. This supply shock then percolates through the system over the next 12 to 18 months, culminating in a massive parabolic price peak. The most recent halving just happened in April of 2024. The engine has been turned on. The countdown clock has started. If history is any guide, if the pattern holds even remotely true, we are now in the early stages of the bull market, the part where the smart money accumulates before the mania begins. The historical timeline points directly to a cycle peak somewhere between late 2025 and mid-2026. This is our anchor point. This predictable, unchangeable, code-based supply shock is the fundamental catalyst that sets the stage for everything else. Now, I know what the skeptics are saying, but this time is different. And you know what? They're absolutely right. This time is different, but it's different in ways that make this cycle potentially more explosive, not less. In previous cycles, the demand for Bitcoin was driven almost entirely by retail investors like you and me, tech enthusiasts, and early believers. It was a grassroots movement. But the demand we're seeing now, the demand that's going to collide with this supply shock, it's coming from a completely different universe. It's coming from Wall Street. In 2012, Bitcoin was a niche curiosity for cypherpunks. In 2016, it was a speculative asset for tech-savvy retail investors. In 2020, a few forward-thinking companies like MicroStrategy started buying it. But in 2024, for the first time ever, we have spot Bitcoin ETFs in the United States. This is not a small development. This is a seismic shift that cannot be overstated. This is the financial equivalent of building a multi-lane superhighway directly from the largest pools of capital in the world, pensions, endowments, 401ks, sovereign wealth funds, straight into the heart of the Bitcoin ecosystem. We are talking about trillions upon trillions of dollars that can now access this asset class with the click of a button, through trusted names like BlackRock, Fidelity, and Franklin Templeton. BlackRock alone manages over $10 trillion in assets. That's trillion with a T. If they allocate just a tiny fraction, a mere 1% of their assets under management into Bitcoin, that's $100 billion of new demand. That single allocation would be more than double the entire market cap of Bitcoin back at the peak of the 2017 bull run. This isn't retail FOMO. This is a tectonic plate of global finance shifting beneath our feet. The halving creates the scarcity, the predictable supply squeeze that acts as the spark. But this new, unprecedented, and relentless institutional demand is the rocket fuel. It's a force multiplier that we have never, ever seen before in any previous cycle. We used to wonder if institutions would ever come to crypto. Now, the question is how we'll handle the tidal wave now that they're here. The floodgates have been opened, and the collision of this institutional demand with the post-halving supply shock is the primary thesis for why 2026 isn't just another cycle peak, but potentially a supercycle that will dwarf everything we've seen before. The halving is the predictable rhythm, the heartbeat we can count on. But the institutionalization of Bitcoin and the broader crypto asset class, that's the game changer. That's the first pillar that makes this time profoundly different. And it's just one of the four major forces we need to understand. Because what's coming next, in the realm of regulation, could be the final green light Wall Street has been waiting for. For years, the story of crypto regulation in the United States wasn't a story. It was a horror movie. The monster under the bed was the Securities and Exchange Commission, the SEC. Every time the market started to show signs of life, you could almost hear the ominous music start to play. A speech from the chairman, a new lawsuit, a press release hinting at a crackdown. It was a strategy of regulation by enforcement, which is a fancy way of saying nobody tells you the rules of the game, they just tell you when you've lost. This approach created a cloud of paralyzing uncertainty. It was the single biggest reason your financial advisor would laugh you out of the room if you mentioned Bitcoin. It was the reason giant pension funds and insurance companies, the ones with trillions of dollars in assets, couldn't touch crypto with a 10-foot pole. The career risk was just too high. How could a fund manager justify allocating billions to an asset class that the most powerful regulator in the world seemed determined to sue out of existence? They couldn't. And so, the industry was stuck in a holding pattern. Projects were terrified to launch and the US exchanges operated under a constant threat. And investors were left to guess which token would be the next one declared an illegal security. This wasn't just a hurdle, it was a wall. A giant, electrified, razor-wire-topped wall designed to keep institutional money out. The narrative was simple. Crypto is the Wild West, and the sheriff is coming to shut it down. But then something shifted. The wall didn't just get a crack in it. It was hit by a legal wrecking ball. That wrecking ball was Grayscale. For years, the SEC had been denying every single application for a spot Bitcoin ETF, using a series of increasingly flimsy excuses. Grayscale, which ran a massive Bitcoin trust, saw the writing on the wall and they did something most people thought was insane. They sued the SEC. The little crypto company decided to take on the financial titan. And in August of 2023, the impossible happened. They won. A federal appeals court handed down a scathing ruling, calling the SEC's denial of Grayscale's application arbitrary and capricious. Those weren't my words. Those were the words of the U.S. Court of Appeals. The judges basically said the SEC had no logical reason to approve Bitcoin futures ETFs, while denying spot ETFs. They had been caught playing games and the court called them on it. This was the moment the entire narrative changed. It was a tectonic shift. The SEC, the big bad wolf of crypto, had been publicly overruled. They were forced, against their will, to approve the spot Bitcoin ETFs in January 2024. This wasn't the regulator benevolently granting permission. This was the regulator being dragged, kicking and screaming, into the future. That single court case did more for regulatory progress than a decade of lobbying. Proved that the industry wasn't just going to roll over. and it set a powerful precedent. The floodgates didn't just open for Bitcoin. Suddenly, the question wasn't if an Ethereum ETF would be approved, but when. The logic was the same. And this victory in the courts lit a fire under the one group that can provide true, lasting clarity: Congress. For the first time, we are seeing a serious bipartisan push to create a comprehensive regulatory framework for digital assets in the United States. It's a bill called the Financial Innovation and Technology for the 21st Century Act, or FIT21. Now, you don't need to know the details of every section, but you need to understand what it represents. It represents the end of regulation by enforcement. It's a plan to draw clear lines. It creates a process for determining if a digital asset is a commodity, to be regulated by the CFTC, or a security, to be regulated by the SEC. This is the Holy Grail. This is what every major financial institution has been begging for. A clear rulebook, a set of guidelines that tells them how they can participate, how they can build products, and how they can custody assets without the fear of a surprise lawsuit wiping them out. The House of Representatives passed this bill with startling bipartisan support. Dozens of Democrats crossed the aisle to vote yes. This isn't a partisan issue anymore. It's becoming an American innovation issue. And this brings us to the political dimension, which might be the most powerful accelerant of all. Crypto has officially entered the political arena as a major talking point. In the run-up to a presidential election, candidates are being asked about their stance on Bitcoin. They're making statements about the right to self-custody. They are talking about keeping crypto innovation in America, not driving it overseas to places like Dubai or Singapore. Think about how profound that is. Just 4 years ago, crypto was a fringe topic that no serious politician would touch. Today, it's becoming a litmus test for being pro-technology and pro-innovation. Being overtly anti-crypto is starting to look like being anti-internet in 1998. It's becoming a politically dangerous position to hold, especially when it comes to engaging younger voters. So, what does this mean for 2026? It means the single greatest headwind crypto has ever faced is in the process of flipping into its single greatest tailwind. The regulatory uncertainty that kept trillions of dollars on the sidelines is evaporating. It's being replaced by regulatory clarity. This de-risks the entire asset class for the big money players. The boardrooms at Morgan Stanley, at state pension funds, at university endowments, their conversations are changing. The question is no longer, is this legal? Or will we get sued? The question is becoming, what is our allocation strategy? And how do we not get left behind? The United States has a choice to make. It can either be a leader in the next generation of financial technology, or it can be a spectator. And all signs now point to the US choosing to lead. The legislative momentum, the judicial precedents, and the political pressure are all converging towards one outcome: a clear, sanctioned, and regulated environment for digital assets. This is the second pillar. The first was the institutional vehicle, the ETF, that allows capital to flow in. This second pillar is the regulatory green light that tells that capital it's safe to do so. The money now has a car, and the government is paving the road. But with the money flowing in and the regulators giving the green light, there's just one problem. Does the technology actually work at scale? Because all the money and all the rules in the world don't matter if the engine can't handle the traffic. And the answer to that question, the third pillar of our 2026 outlook, is where the next $1 trillion will be made or lost. That engine is the technology itself. The code, the architecture that underpins this entire digital world. We call it the problem of scalability. It's a simple word for a monstrously complex challenge, one that has been the single biggest bottleneck for crypto since its inception. Think of it like this. In the early days of the internet, we had dial-up. It worked, it proved the concept, but you couldn't stream Netflix on it. Bitcoin and early Ethereum were the dial-up of crypto. They proved that a decentralized, secure digital ledger was possible. But when everyone tried to use it at once, the whole system ground to a halt. This isn't a theoretical problem. It's a real painful memory for anyone who was in the market during previous cycles. Remember 2017? A game called CryptoKitties, where you could buy and breed digital cats, became so popular that it literally congested the entire Ethereum network. Transactions took hours, sometimes days, and cost a fortune. The network, the supposed future of finance, was brought to its knees by cartoon cats. Then, in 2021, during the DeFi summer and the NFT boom, it happened again. Gas fees, the cost to do anything on Ethereum, skyrocketed to hundreds, sometimes thousands of dollars for a single transaction. It was like trying to drive in Manhattan at 5 p.m., but every toll booth was demanding $1,000. The dream of a decentralized financial system for everyone became a playground for the rich, pricing out the average user completely. This is the core of the blockchain trilemma, a concept first coined by Vitalik Buterin, the founder of Ethereum. It states that a blockchain can have any two of the following three properties, but never all three: decentralization, security, and scalability. Bitcoin and Ethereum are incredibly decentralized and secure, but they sacrifice scalability. They can only process a handful of transactions per second. Visa, by contrast, can handle tens of thousands. To go mainstream, to handle the traffic from a billion users, crypto had to solve this trilemma. And the race to do so ignited one of the most ferocious and expensive arms races in tech history. This first phase of the war was what we now call the Layer 1 wars. The premise was simple. Ethereum is slow, so let's just build a better, faster blockchain from the ground up. This gave rise to a whole generation of so-called Ethereum killers. Projects like Solana, Avalanche, Cardano, Phantom. Each one was a new challenger stepping into the ring, promising lightning-fast speeds and near-zero fees. They were built with different code, different consensus mechanisms, and they all attracted billions in venture capital funding. Solana, for example, took a brute force approach. It was designed for pure raw speed, capable of handling thousands of transactions per second. Felt like magic to use, but it came at a cost. To achieve that speed, it sacrificed some decentralization, relying on a smaller number of incredibly powerful computers, or validators. This led to a series of high-profile network outages, where the entire chain just stopped. It was like a Ferrari that could break land speed records, but occasionally the engine would just fall out on the highway. Avalanche took a different approach with its subnets, creating a network of interconnected chains. It was a brilliant idea, but it also created complexity. Each new project was a bold experiment, a different bet on how to balance the trilemma. For a while it was a brutal winner-take-all cage match. Every new Layer 1 was marketed as the final answer, the one chain to rule them all. But a funny thing happened on the way to Ethereum's funeral. It refused to die. It had the network effect. It had the most developers, the most users, and the most battle-tested security. Killing it was like trying to replace the English language. It was too entrenched. So the market started to realize that trying to build a single, perfect blockchain that did everything for everyone was the wrong approach. The question wasn't who can build a faster car? The question became, how do we build a better highway system? And that's where the narrative completely shifted, leading us to where we are today, and what will dominate through 2026. The answer wasn't to kill Ethereum, but to build on top of it. This is the era of Layer 2s. If Ethereum is the main highway, incredibly secure, but often congested, a Layer 2 is a massive multi-lane express highway built directly on top of it. They handle the bulk of the traffic, the day-to-day transactions, at incredible speeds and for a fraction of the cost. They process thousands of transactions off to the side, bundle them up into a single compressed package, and then post a tiny cryptographic receipt back down to the main Ethereum highway. By doing this, they inherit the security and decentralization of Ethereum, while achieving the scalability the main chain could only dream of. It's the best of both worlds. This isn't a future promise. It's happening right now. Projects like Arbitrum and Optimism are already processing more transactions daily than Ethereum itself. They have their own thriving ecosystems of apps, games, and financial tools. Using a Layer 2 feels like what we were always promised crypto would be: fast, cheap, and accessible. And the technology is only getting better. We're seeing the rise of a new breed of Layer 2s called ZK rollups, which use advanced cryptography to offer even greater efficiency and security. Think of them as the next generation of hyper-efficient express lanes. So for 2026, the Layer 1 wars are largely over. The market has decided that betting against Ethereum's security and network effect is a losing game. Instead, the real battle, the real innovation, and the real opportunity will be in this Layer 2 space. Which scaling solution will attract the most users? Which technology will prove to be the most robust and developer-friendly? This is where the competition is white-hot. But there's one more evolution on the horizon. One that's just starting to take shape, but will likely be the dominant paradigm by the time we get to 2026. It's called the modular thesis. If Layer 1s were like buying a pre-built Dell computer, everything in one box, and Layer 2s were like adding a powerful graphics card to it, the modular approach is like building a custom PC from scratch, picking the best possible component for each individual job. Instead of one blockchain trying to do everything, execution, data storage, and security, a modular stack separates these jobs. You might use Ethereum, the most secure chain in the world, as your security and settlement layer. That's its specialty. But for data availability, just storing the raw data of transactions, you might use a specialized network like Celestia, which is designed to do that one thing cheaper and more efficiently than anyone else. Then, for the actual execution of transactions, you can build your own hyper-optimized Layer 2 or even a Layer 3 that plugs into this stack. It's like blockchain Legos. You can mix and match the best-in-class components to build applications that are tailored for a specific purpose, whether it's a high-frequency trading platform, a massive online game, or a social media network. This shatters the constraints of the trilemma because no single chain has to do everything. Each component is specialized. This is the ultimate endgame for scalability. It allows for near-infinite customization and efficiency. So, as we look towards 2026, the engine of crypto is being completely rebuilt. We're moving from a monolithic world of competing Layer 1s to a collaborative and interconnected world of Layer 2s, all settling on a secure base layer. And beyond that, we're moving towards a fully modular future where developers can assemble the perfect blockchain for their needs like a set of building blocks. Understanding this technological shift is everything. It's the difference between betting on blockbuster video in the age of Netflix. The money, the developers, and the users are all flowing up the stack, from the base layers to these new hyper-efficient scaling solutions. This is the infrastructure that will finally be able to handle 1 billion users. This is the engine that can power a global, decentralized economy. But a powerful engine is useless without cars to drive on the new highways. An infinitely scalable blockchain is just a ghost town without compelling applications that people actually want to use. And that brings us to the fourth and perhaps most important pillar of our 2026 outlook. What will be the killer app? What are the specific sectors and use cases that will finally break through to the mainstream and bring tens of millions of new users into this ecosystem? This question is the billion-dollar, no trillion-dollar question. Because technology on its own is meaningless to most people. Think about the early internet. Nobody outside of a few university labs cared about TCP, IP, or HTTP protocols. They were complex, arcane, and utterly irrelevant to daily life. What did people care about? They cared about AOL and email. They cared about connecting with family across the country. They cared about GeoCities and building their first clunky web page. They cared about the application that the technology enabled. The killer app is the friendly face on the revolutionary technology. It's the bridge from the abstract to the essential. For crypto to reach its 2026 potential, it needs to stop talking about ZK rollups and start delivering experiences that are 10 times better than the alternative. So where will we find them? Let's break down the 3 most likely contenders to produce the next crypto killer app. First, and perhaps the most obvious, is the evolution of decentralized finance, or what we can call DeFi 2.0. The first wave of DeFi in 2020 and 2021 was a fascinating Wild West experiment. It proved that complex financial transactions like lending, borrowing, and trading could happen without a bank. But let's be honest, it was a nightmare for the average person. It was clunky, expensive with gas fees, and felt like you needed a PhD in computer science to participate without losing all your money. That is not a killer app. That's a niche product for tech-savvy risk-takers. DeFi 2.0, the version we'll see maturing by 2026, will be different. Its mantra will be abstraction. All that mind-numbing complexity will be pushed to the background, hidden behind interfaces as slick and simple as Robinhood or Venmo. The killer app in this space won't even market itself as DeFi. It'll market itself as a smarter savings account or instant business financing. And the fuel for this fire is the tokenization of real-world assets, or RWAs. This is one of the most powerful and underestimated narratives in all of crypto. We're talking about taking tangible real-world things, a piece of commercial real estate, a portfolio of fine wine, a government bond, a company's future revenue, and representing them as a digital token on a blockchain. Imagine this. By 2026, you don't go to a bank for a mortgage. You go to an app. You tokenize the deed to your house, and within minutes, a global pool of lenders, from a hedge fund in Singapore to an individual investor in Ohio, can bid to provide you capital, all governed by a smart contract. The friction, the paperwork, the middlemen, all of it gone. Imagine a small business owner who needs a loan. Instead of begging a bank manager, they tokenize their future invoices and get instant liquidity from a decentralized protocol. This isn't just a slightly better way of doing things. This is a fundamental rewiring of the plumbing of finance. The killer app here will be the one that makes accessing this global, efficient ocean of capital as easy as ordering an Uber. Our second major contender is the one that has the potential to onboard the next 100 million users faster than any other: blockchain gaming. Again, the first attempt at this, the play-to-earn model, was a flawed experiment. Games like Axie Infinity became more like a job than a game. The moment the financial incentives dried up, the player base collapsed, because the game itself wasn't fun enough to keep them there. The industry learned a painful but vital lesson. The new model emerging for 2026 is play and own. The focus is reversed. First, you make a game that is genuinely addictively fun. A game that could compete with the likes of Fortnite, Call of Duty, or World of Warcraft on its own merits. Then, you seamlessly integrate blockchain elements to give players true ownership of their in-game items. Think about what this means. The average serious gamer spends hundreds, if not thousands, of dollars on skins, weapons, and cosmetic items. Right now, that money is just gone. It's a rental fee paid to a company for pixels you can't do anything with. In a play-and-own world, that rare sword you spent 100 hours grinding for, or that limited edition skin you bought, it's yours. It's an NFT in your wallet. You can sell it on an open marketplace. You can trade it with a friend. In the future, you might even be able to take it with you into a different game. By 2026, we're not going to be talking about clunky crypto games. We're going to see a AAA blockbuster title developed by a major studio that has this ownership economy built into its core. It won't be a crypto game. It will be an amazing game that just happens to use crypto to give its players superpowers. For the 3 billion gamers on this planet, the idea of truly owning their digital life and their investment of time and money is a revolutionary concept. The first studio to crack this code won't just have a hit game. They'll have created a new economic paradigm. Our third, and perhaps most culturally significant contender, is decentralized social media, or DeSo. There is a palpable, growing dissatisfaction with the current state of the internet. We feel it every day. Our data is harvested and sold. Our feeds are manipulated by opaque algorithms designed to make us angry or anxious. Our digital identities are trapped within the walled gardens of a few tech giants. If you build a following of 1 million people on a platform, you don't own that audience. The platform does, and they can take it away from you in a heartbeat. DeSo offers a radically different vision. A social network where you, the user, are the platform. Imagine a version of Twitter, let's call it Open Twitter for 2026, built on a decentralized protocol. Your profile is your wallet address. Your username is an NFT you own and can sell. Every post you make is your property. Your social graph, the list of people you follow, is a public good that you can take with you to any other app built on that same protocol. Censorship becomes exponentially harder because there's no central server to shut down. Most importantly, the economic relationship is flipped on its head. Instead of the platform monetizing your attention by selling ads, creators can monetize directly from their followers through subscriptions, tips, or selling their content as NFTs, all with minimal fees. The killer app here will be the one that combines the seamless user experience of a Web2 platform with the powerful promise of digital sovereignty. It will tap into a deep-seated desire for control and ownership that many people are only just now beginning to feel. But here's the real secret. The ultimate killer app for 2026 might not be DeFi, or gaming, or social media. The ultimate killer app might be the interoperability between them all. Let me paint you a picture of what this actually looks like. Meet Jane in 2026. She's playing a massive online game and earns a legendary one-of-a-kind digital helmet. That helmet is an NFT in her crypto wallet. She needs some cash for a down payment on a new car. So she goes to a DeFi app, and without selling her prized helmet, she uses it as collateral to take out an instant loan. The DeFi protocol can verify the helmet's rarity and market value on-chain, and gives her the funds in seconds. She uses some of those funds to buy a piece of digital art from an up-and-coming artist she discovered on her decentralized social feed, sending the payment directly to the artist's wallet. She then takes that digital art and displays it in her personalized virtual home in the metaverse, which she accesses through the same digital identity she uses for gaming and finance. That entire sequence, from game to finance to social to metaverse, is impossible in the world of Web 2. It's a seamless flow of value and data across different applications, all anchored by user ownership. That is the experience that no centralized company can replicate. The killer app isn't a single product. It's the emergence of a new user-owned internet. An internet where our digital lives and our economic lives are finally one and the same. Of course, for this interconnected digital world to function, For millions of transactions to flow seamlessly between games, financial apps, and social networks, the underlying infrastructure has to be absolutely rock solid. It needs to be lightning fast, dirt cheap, and unbreakably secure. This brings us to the fifth pillar of our 2026 outlook: the great infrastructure wars. The battle of the blockchains. Who will be the foundational layer that powers this new internet of value? Will it be Ethereum and its army of layer 2s? Or will a new challenger rise to take the throne? To answer that, we have to start with the reigning king, the undisputed heavyweight champion, Ethereum. By 2026, Ethereum's position won't be just about technology. It will be about its gravitational pull. Think of it less like a single company and more like a digital nation-state. It has the largest population of developers, the most established infrastructure, and the highest value real estate in the entire digital world. Its security is battle-hardened over years of constant attacks, making it the trusted settlement layer for hundreds of billions of dollars in value. The core of Ethereum's strategy for 2026 isn't to get faster itself. That's a common misconception. Instead, it's outsourcing speed and execution to its sprawling empire of layer 2s. This is the most crucial concept to grasp. Ethereum is becoming the ultimate foundation, the bedrock security layer. While chains like Arbitrum, Optimism, Polygon, ZK Sync, and Starknet act as bustling superhighways built on top of it. They handle the millions of daily transactions, the DeFi trades, the NFT mints, the gaming interactions, at a fraction of the cost and a multiple of the speed. Then, they bundle all those transactions up and settle them in a single secure batch on the main Ethereum blockchain. It's a modular approach. Ethereum is handling security and decentralization, while the layer 2s handle scale. By 2026, the average user might not even directly interact with the Ethereum mainnet. They'll live on the layer 2s, enjoying a fast, cheap experience, without even realizing the immense security of the base layers protecting their every move. This is Ethereum's grand vision: to become the global settlement layer for digital value, the ultimate court of appeals where all transactions find their final, immutable truth. Its moat is deep, fortified by network effects that are almost impossible to replicate. But this empire is not without its vulnerabilities. The modular vision is incredibly complex. Coordinating upgrades between the main chain and dozens of layer 2s is a monumental technical and political challenge. And while layer 2s make transactions cheap, moving value between them, or from the mainnet to them, can still be a clunky and sometimes expensive process. Ethereum's core weakness remains its user experience for the uninitiated. It's powerful, but it's not yet simple. And in the world of technology, complexity is a vulnerability that hungry competitors love to exploit. Enter the challengers, the so-called Ethereum killers. But let's be clear, that term is a relic of the 2021 bull market. By 2026, the narrative isn't about killing Ethereum. It's about outcompeting it on specific fronts. It's about offering a different value proposition, a different philosophy. And the leader of this rebellion, the one that has proven its resilience time and time again, is Solana. If Ethereum is building a modular city with specialized districts, Solana is building a single monolithic skyscraper where everything happens under one roof, at lightning speed. Solana's core thesis is that hardware and bandwidth will continue to get exponentially cheaper. So instead of offloading execution to layer 2s, they are building a single blockchain that aims to be fast enough for everything. We're talking tens of thousands of transactions per second, for fractions of a penny. This makes it an ideal environment for applications that require insane throughput. Things like decentralized social media, high-frequency crypto trading, or on-chain gaming where every action is a transaction. Of course, Solana has its own scars. The network outages of the past were a serious black mark, raising questions about its stability. But its developers have been relentlessly shipping fixes and upgrades. What's compelling about Solana for 2026 is its sheer developer momentum and its tight-knit, almost cult-like community. It has survived a near-death experience after the FTX collapse, and has come roaring back, stronger and more decentralized than before. By 2026, the bet on Solana is a bet that a single, hyper-optimized, monolithic chain will ultimately provide a better user and developer experience than Ethereum's more complex, modular ecosystem. It's a battle of architectural philosophies. But the war isn't just a two-horse race. There are other powerful factions emerging. Look at chains like Aptos and Sway. These are the new kids on the block, born out of Facebook's abandoned crypto project. They come with a new programming language called Move, designed from the ground up to be safer and more efficient for managing digital assets. They have massive venture capital war chests and are led by some of the brightest minds in computer science. Their strategy is to leapfrog the current generation of blockchains with superior technology. While they haven't captured the same level of user adoption yet, by 2026, their tech will have had years to mature. They represent a dark horse, a bet on a fundamentally new technological stack winning out in the long run. Then you have ecosystems like Avalanche with its subnets, which allow applications to launch their own custom, interconnected blockchains. Or Cosmos, the Internet of Blockchains, which focuses on creating a standard for different chains to communicate with each other. And this brings us to the real paradigm shift for 2026. The winner of the infrastructure wars might not be a single blockchain at all. The most important innovation might be the technology that connects them. The future is not a single chain, but a multi-chain world. Think of it like the real world. We have different countries with different laws and languages, but we also have shipping lanes, flight routes, and the internet that connect them all, allowing for global trade and communication. In crypto, these are the interoperability protocols. Projects like Layer 0, Wormhole, and Chainlink CCIP are building the fundamental pipes and bridges that will allow value and information to flow seamlessly between Ethereum, Solana, Avalanche, and all the others. By 2026, you might hold a digital asset on an Ethereum Layer 2, use it in a game on Solana, and then lend it out in a DeFi protocol on Aptos, all in a single fluid user experience without ever having to think about the underlying plumbing. The war will shift from which chain is the best to which chain is best for a specific task. The key metric to watch will no longer just be total value locked or TVL. The real leading indicators for 2026 will be daily active users and, most importantly, developer activity. Where are the smartest builders choosing to spend their time? Which ecosystem is making it easiest to build, launch, and scale a new application? So our 2026 outlook is this: a multipolar world. Ethereum, with its massive network effect and Layer 2 ecosystem, will likely solidify its position as the premium global settlement layer. It's the digital world's equivalent of New York City, the center for high finance, blue-chip assets, and institutional capital, where security is paramount. Solana will be the high-throughput hub, the Las Vegas or Tokyo, optimized for consumer applications, gaming, and anything that requires immense speed and low cost. It will thrive on volume and user activity, and new, technologically advanced chains like Aptos and Sway, along with specialized ecosystems like Cosmos, will carve out their own sovereign niches, attracting developers who want to build on the next generation of technology. The great infrastructure war of 2026 won't have a single victor who takes all the spoils. Instead, it will result in a vibrant, interconnected tapestry of blockchains, each with its own strengths and trade-offs. The ultimate winners will be the users and developers who can finally pick the right tool for the right job. But as these digital nations get built, a critical question emerges. If these are the new economies, what is their currency? What is the money that flows through these digital pipes? This isn't just about volatile assets like Bitcoin or Ether. It's about a new kind of money, one that's stable, programmable, and connected to the real world. Enter the era of stablecoins. For years, the biggest barrier for mainstream crypto adoption wasn't the complexity or the risk. It was the volatility. How can you build a global digital economy on a currency that can lose 20% of its value while you're sleeping? You can't. It's like trying to build a house during a constant earthquake. You need a stable foundation. You need digital money that behaves like, well, money. Something that holds its value. This is the problem stablecoins were born to solve. They are the ultimate bridge, the translator between the chaotic, innovative world of crypto and the familiar, reliable world of the US dollar. The first generation of these bridges were simple but revolutionary. Giants like Tether or USDT and Circle's USDC. Their promise was straightforward. For every one digital dollar we issue on the blockchain, we hold one real US dollar, or a highly liquid equivalent like a treasury bill, in a real audited bank account. It's a digital IOU, backed one-to-one by cold, hard cash. This solved the immediate problem. Suddenly, traders had a safe harbor. They could exit a volatile Bitcoin or Ethereum position without having to go through the slow, expensive process of cashing out to their traditional bank account. They could just move into USDC and wait for the storm to pass. It became the grease in the wheels of the entire multi-trillion-dollar crypto trading machine. But with this great power came intense scrutiny. For years, the market was haunted by a single terrifying question. Is the money really there? Are the reserves backing these tens of billions of digital dollars fully accounted for? This fear, this uncertainty, created a dark cloud over the industry. But what it also did was force a reckoning. It accelerated a push for transparency and regulation that was long overdue. The era of "trust me, bro" was ending. Now, these major stablecoin issuers are subject to regular attestations and are moving towards full, independent audits. They're registering with regulatory bodies. The pressure is on, and by 2026, the largest stablecoins won't just be tech companies. They'll be regulated financial institutions, held to the same standards as the banks they sought to disrupt. They have to be, because they are becoming the foundational layer for everything that comes next. But the crypto world is never satisfied with a centralized solution. The reliance on banks and auditors felt like a compromise of the core ethos of decentralization. So, a new, wildly ambitious experiment began: the algorithmic stablecoin. The idea was pure genius in theory. What if you could create a stable digital dollar without any real dollars in a bank? What if you could use complex code, smart contracts, and a second volatile token to automatically maintain a $1 peg? The poster child for this dream was Terra USD, or UST, and its sister token Luna. It wasn't backed by dollars, it was backed by an algorithm. When the price of UST went above $1, the algorithm would create more of it to bring the price down. When it fell below $1, it would use the value of Luna to buy up UST and push the price back up. For a while it worked. Seemed like magic. Billions of dollars poured in, chasing high yields in its ecosystem. It was hailed as the future of decentralized money. And then in May of 2022, the magic failed. The algorithm broke. A series of massive coordinated withdrawals triggered what is now infamously known as a death spiral. As UST lost its peg to the dollar, the algorithm frantically printed trillions of Luna tokens to try and prop it up, destroying Luna's value. This, in turn, completely shattered confidence in UST's backing. It was like trying to build a skyscraper on a foundation of shifting sand. In the span of a week, over $40 billion in value was vaporized. It was a brutal, catastrophic failure. But from the ashes of that failure, the market learned a critical lesson. You cannot create value and stability out of thin air. Trust needs an anchor. Code alone isn't enough. You need something real. And that realization is what's fueling the single most important trend that will define the crypto landscape in 2026. The tokenization of real-world assets. RWA. Get used to that acronym because you're going to be hearing it everywhere. If first-generation stablecoins were about putting dollars in a bank onto the blockchain, RWAs are about putting everything else on the blockchain. We're talking about tangible, income-producing assets from the traditional financial world. U.S. Treasury bills, corporate bonds, private credit loans, real estate, art. These are the assets that have powered the global economy for centuries. And now they are being reborn as digital tokens. Think about it. BlackRock, the world's largest asset manager with over $10 trillion under its watch, has launched a tokenized fund on the Ethereum network called BUIDL. This fund doesn't hold crypto. It holds U.S. Treasury bills. Investors put in dollars, and in return they get a digital token that represents their share of the fund. That token now lives on the blockchain. It can be transferred anywhere in the world 24/7 in seconds for a fraction of a penny. The interest payments from the T-bills? They're paid out directly to the token holders' digital wallets every single day. This is not a niche experiment. This is the paradigm shift. Larry Fink, the CEO of BlackRock, has said that the tokenization of every financial asset is the next generation for markets. And why is this so powerful? 3 reasons. First, it brings sustainable real-world yield into the digital world. The speculative high-risk yield farming of the past is being replaced by the stable, predictable interest earned from a U.S. government bond or a loan to a blue-chip company. This is the kind of safety and predictability that attracts serious institutional capital. Second, it brings radical transparency. Instead of a quarterly report, you have a public ledger that can be audited by anyone at any time. You can see exactly what assets are backing a token in real time. This eliminates layers of intermediaries, auditors, and back-office costs. It's a direct, verifiable link between the digital token and the real-world value it represents. And third, it creates unprecedented liquidity. Take an asset like a commercial real estate building or a private credit portfolio. These are multi-million-dollar assets that are notoriously difficult to buy and sell. The process can take months. By tokenizing it, you can slice it into 1 million digital pieces. Suddenly, an illiquid asset becomes as easy to trade as a stock. You can buy or sell a fraction of an office building on a decentralized exchange from your phone on a Sunday night. By 2026, this won't be a novelty. It will be the standard. The trillions of dollars locked up in these real-world assets will begin their great migration onto the blockchain. The money flowing through these digital pipes won't just be volatile cryptocurrencies anymore. It will be tokenized US treasuries, tokenized stocks, tokenized mortgages. The line between traditional finance and decentralized finance will blur until it's almost unrecognizable. This is the maturation of the industry. It's the evolution from a purely speculative casino to a foundational technology layer for the entire global financial system. We are upgrading the plumbing of finance itself, making it faster, cheaper, more transparent, and more accessible than ever before. So we have the digital economies, and now we have the stable, programmable, real-world backed money to power them. The foundation is being laid. But what do you build on top of it? What are the killer applications that will use this new financial plumbing to completely reinvent how we bank, invest, and insure? That's where the real revolution begins. The first killer application, the one that truly shows the world what this technology is for, is already here. It's a sector we call decentralized finance, or DeFi. And it's not just a new app or a new website. It's a parallel financial system being built from the ground up, one that's aiming a cannon directly at the $100 trillion fortress of traditional banking. And the first target, the oldest business in the world, lending and borrowing. Think about how you get a loan today. You walk into a bank, fill out a mountain of paperwork, submit your credit score, your income history, your life story. A committee of people you'll never meet decides if you're worthy. The process is slow, it's opaque, and it's riddled with bias. It's a system built on gatekeepers. Now, imagine a global, automated lending machine that never sleeps. It doesn't have offices. It doesn't have loan officers. It doesn't care about your credit score, where you live, or what you look like. All it cares about is collateral. This is the reality of protocols like Aave and Compound. They are massive, decentralized pools of capital. If you have crypto assets, you can deposit them and start earning interest instantly, often at rates that make your bank savings account look like a joke. Why? Because there's no massive corporate overhead. There are no bonuses for executives. It's just code. But the other side is even more revolutionary. If you need to borrow money, you can post your crypto as collateral and receive a loan in seconds. Not days, not weeks. Seconds. At 3 a.m. on a Sunday. From anywhere in the world with an internet connection. This is the financial equivalent of upgrading from a horse and buggy to a fighter jet. By 2026, we're not just talking about borrowing against your Bitcoin or Ethereum. We're talking about the tokenization of everything. Imagine depositing a token that represents a share of your home equity, or a piece of a rental property, or even a percentage of your future business revenue, and getting an instant loan against it. The system becomes a hyper-efficient engine for capital allocation, unlocking liquidity from assets that are currently stuck, illiquid, and tangled in red tape. The banks won't be able to compete on speed or efficiency. They'll be forced to adapt or become relics. But DeFi doesn't stop at lending. What about the stock market? The New York Stock Exchange, the Nasdaq. These are centralized behemoths. They have opening and closing bells. They can halt trading on a whim if things get too volatile. They are central points of failure. Remember when Robinhood and other brokers just stopped letting people buy certain stocks? That's what centralization gets you. Someone else is always in control. The decentralized answer to this is the automated market maker, or AMM. The most famous example is Uniswap. There's no company in the middle. There's no order book where buyers and sellers are matched by a central entity. Instead, there are just giant pools of two different assets, say Ethereum and the USDC stablecoin. The price is determined by a simple mathematical formula based on the ratio of those two assets in the pool. When you want to trade, you aren't trading with another person. You're trading directly with the pool with the smart contract. This is a profound shift. It means trading can happen 24/7/365. Can never be shut down. There is no CEO to subpoena. There are no circuit breakers to trip. As long as the Ethereum blockchain is running, Uniswap is running. It's a truly global, unstoppable marketplace. Now project that forward to 2026. Right now, these decentralized exchanges, or DEXs, mostly trade crypto assets. But the technology is agnostic. It doesn't care what the tokens represent. As tokenized stocks, bonds, commodities, and real estate become a reality, these DEXs will be there to trade them. Imagine a single global liquidity pool where you can seamlessly swap from a token representing an Apple share to a token representing a barrel of oil, to a token representing an ounce of gold, all in one transaction, with no middleman, in the middle of the night. The volume flowing through these protocols could one day rival, and then surpass, the volume on the world's traditional stock exchanges. We're talking about a multi-trillion-dollar migration of value. And then you get to the really advanced stuff. The financial Legos that can be stacked on top of this foundation. Think about insurance. One of the biggest risks in DeFi is a bug in the code of a smart contract. So what happens? A decentralized insurance protocol like Nexus Mutual emerges, where users can pool capital together to offer coverage against these specific risks. You're not buying a policy from a giant corporation in a skyscraper. You're buying a contract from a global pool of your peers. Or consider derivatives, the contracts that let you bet on the future price of an asset without actually owning it. This is a quadrillion-dollar market in traditional finance, the biggest market in the world. Protocols like Synthetics are building this on-chain, allowing anyone to get financial exposure to literally any asset with a reliable price feed. You want to bet on the price of Tesla stock, the Swiss franc, or Japanese real estate from your laptop in Ohio without a broker? Decentralized derivatives make that possible. What we are witnessing is the assembly of a new financial stack for the internet. Each piece, lending, exchanging, insurance, derivatives, is a transparent open-source protocol. They are designed to be interoperable, to plug into each other like Lego bricks, creating a system far more dynamic and innovative than the siloed, ancient infrastructure of Wall Street. By 2026, the complexity and sophistication of these interconnected protocols will be staggering. We'll see strategies and products emerge that we can't even conceive of today, all running on automated, transparent code. This isn't about simply rebuilding the old system on new rails. It's about creating something fundamentally different, a system that is more open, more efficient, and accessible to anyone, not just the privileged few. But there's a giant elephant in the room. This all sounds incredible, right? A financial revolution. But how many people do you know who have actually used Aave or Uniswap? Probably not many. Because for all its power, for all its revolutionary potential, there is a massive, glaring problem. Using this stuff is still way too hard. It's confusing, it's intimidating, and for the average person, it's a minefield of technical jargon and terrifying risk. The killer apps are here, but the door to use them is still locked for 99% of the world. So how do we get from a niche, expert-only ecosystem to true global mass adoption? How do we build the on-ramps and the user experiences that make this as easy as using Venmo or Robinhood? That's the billion-user question, and it's the key that unlocks everything we've just talked about. The answer isn't a single magical killer app. It's not one project that suddenly cracks the code. Instead, the path to 1 billion users is paved by 4 fundamental pillars, for massive shifts that are happening right now under the surface. When they converge, they won't just lower the barrier to entry. They'll obliterate it entirely. The first, and arguably the most important, is the Great Abstraction. Think about the internet. You don't need to know what TCP, IP, or DNS is to watch this video. You just open your browser, type in YouTube, and it works. Your browser, your operating system, they handle all the insane complexity behind the scenes. That's what's coming for crypto. The era of wrestling with 24-word seed phrases, manually setting gas fees, and managing a dozen different wallets for a dozen different chains is coming to a violent end. The technology that powers this is called account abstraction. It's a boring name for a revolutionary concept. Instead of your wallet being a simple, dumb container for keys, it becomes a programmable, smart account. What does this mean for you, the user? It means you can have a crypto account that feels exactly like your Chase Bank account. It means you can recover your account using your email and a password, or by getting approval from a few trusted friends, just like a social media account. No more terrifying risk of losing your life savings because you misplaced a piece of paper. It means you can pay for transaction fees using the stablecoins you already have, like USDC, instead of needing to hold a specific volatile gas token like Ether. Imagine trying to buy a coffee with your credit card, but first you have to buy shares in Visa stock just to pay the transaction fee. It's absurd, and it's going away. Account abstraction bundles complex actions into a single click. One button to stake, provide liquidity, and borrow, all in a seamless flow. By 2026, the average user won't even know they're using a self-custodial wallet on a blockchain. It will just be their digital account. And it will just work. This isn't a distant dream. It's being built into the core infrastructure of chains like Ethereum and Starknet as we speak. This is the user experience revolution. The second pillar is the tokenization of real-world assets, or RWAs. For years, crypto has been a largely self-referential casino. We traded tokens that represented other tokens. But what happens when a token represents something tangible, something real? That's the multi-trillion-dollar opportunity of RWAs. We're talking about taking assets like commercial real estate, government bonds, private equity, fine art, and putting them on the blockchain. Why is this a game changer? It shatters the wall between traditional finance and decentralized finance. Suddenly, the blockchain isn't just for digital collectibles. It's a global 24/7, hyperliquid ledger for all the world's value. Think about it. Right now, if you want to invest in a private credit fund or a specific commercial building, you need to be an accredited investor, go through mountains of paperwork, and your money is locked up for years. With RWA tokenization, a fund manager can issue tokens representing shares in that asset. You could buy $100 worth of a trophy office building in Miami, earning your share of the rental income paid directly to your wallet every month. You could instantly trade that token on a decentralized exchange if you need liquidity. This isn't just about making finance more efficient for the big players. It's about democratizing access to wealth-generating assets for everyone. BlackRock, the world's largest asset manager, is already launching tokenized funds on public blockchains. They see where this is going. By 2026, investing in a piece of a treasury bond will be as easy as buying a token on Uniswap, bringing trillions of dollars of stable, productive value into the DeFi ecosystem, and giving millions of people a compelling reason to participate beyond speculation. The third pillar is the maturation of the infrastructure layer, specifically Layer 2s and the rise of app chains. The biggest complaint during the last bull run was that using crypto was slow and outrageously expensive. Trying to do anything on Ethereum felt like trying to drive on a Los Angeles freeway at 5 p.m. while paying a $1,000 toll. It was unusable for the average person. Layer 2 scaling solutions like Arbitrum, Optimism, and the new wave of ZK rollups are the superhighways being built on top of that congested freeway. They bundle up thousands of transactions, process them off-chain at lightning speed for pennies, and then post a single compressed proof back to the main Ethereum chain for security. The result? The user experience becomes indistinguishable from a Web 2 application. Transactions are instant and cost a fraction of a cent. This is what allows for applications that require high throughput, things that were impossible before. And it goes a step further with app chains. These are specialized blockchains built for a single purpose, a single application. Imagine if Netflix, instead of running on Amazon's crowded servers, built its own dedicated internet, optimized perfectly for streaming video. That's what an app chain is. It allows developers to customize every single aspect of the chain to create the best possible user experience for their specific game, social network, or trading platform. This combination of cheap, fast Layer 2s and hyper-optimized app chains means that by 2026, the performance excuse will be dead. The tech will finally be ready for prime time, capable of handling hundreds of millions of users without breaking a sweat. Finally, the fourth pillar, and the one that will act as the ultimate Trojan horse, is the convergence of gaming and decentralized social media, or SocialFi. These are the on-ramps for the next 500 million users. People don't come to a new technology for the technology itself. They come for the experiences it enables. And nothing is more engaging than gaming and social connection. The first wave of crypto gaming was dominated by clunky play-to-earn models that felt more like a job than a game. The next wave, which will be in full swing by 2026, is focused on play and own. The emphasis is on fun, high-quality games made by veteran studios that just happen to use blockchain to give players true ownership of their in-game items. Your legendary sword isn't just a line of code on a company's server that they can delete tomorrow. It's a non-fungible token in your wallet. You can sell it, trade it, or maybe even use it in a different game in the same ecosystem. This creates a powerful, persistent digital identity and economy that players have a real stake in. On the social side, platforms like Farcaster and Lens Protocol are building a new foundation where you, the user, own your data, your content, and your social graph. Imagine building up a following of 10,000 people, and if you decide to leave the platform, you can take that audience with you to any other app built on the same protocol. You are not the product anymore. This taps directly into a growing global sentiment of digital sovereignty and a desire to escape the control of big tech. When you combine the seamless experience from account abstraction, the speed of Layer 2s, and the powerful incentive of true ownership, you get a recipe for explosive viral growth. These four pillars: abstraction, real-world assets, scalable infrastructure, and the gaming/social Trojan horse are not independent trends. They are a tightly woven fabric. They feed into each other, creating a powerful flywheel that will pull the entire crypto ecosystem from the fringes of finance and tech into the mainstream of everyday life. And as this flywheel spins faster and faster, it generates an almost irresistible gravitational pull. But gravity can be a treacherous force. For every object pulled into a stable orbit, another can be flung into deep space or pulled into the star to be incinerated. The road to 2026 is not a freshly paved superhighway. It's a treacherous mountain pass, littered with obstacles that could send the entire convoy plummeting into the abyss. And we have to talk about them. We have to be brutally honest about the great filters that stand between today's market and the multi-trillion-dollar ecosystem we've been mapping out. The first, and by far the most formidable, is the regulatory dragon. For years, the crypto industry in the United States has been operating in a state of regulatory purgatory. It's like trying to build a skyscraper in the middle of a jurisdictional tug-of-war, where one agency tells you your building materials are securities, another says they're commodities, and a third is debating whether you even have the right to own the land. This isn't just an inconvenience. It's an existential threat. The lack of clear rules of the road has kept an ocean of institutional capital. We're talking pension funds, sovereign wealth funds, the big conservative money, sitting on the sidelines. They have the capital and the desire, but their compliance departments simply cannot and will not approve 9- and 10-figure investments into an asset class that could be declared illegal or fundamentally altered by a single court ruling or a new piece of legislation. The year 2026 hinges on this. Will the United States finally provide a clear, workable framework? Or will it continue its current approach of regulation by enforcement, effectively strangling the golden goose in its crib while other jurisdictions like Hong Kong, Dubai, and parts of Europe roll out the red carpet? This is the multi-trillion-dollar question. A clear framework, even a strict one, would be the starter pistol for an institutional stampede into crypto. Continued ambiguity, however, will act as a lead weight, slowing the flywheel and potentially ceding America's leadership in this next wave of technological innovation. The second great filter is the technology itself. We've celebrated the rise of Layer 2s and modular blockchains as the solution to the scalability trilemma, and they are brilliant. But let's be clear, they have not yet been battle-tested at the scale we're anticipating. We're talking about a world where 1 billion people are interacting with blockchains daily. Not just trading, but playing games, using social media, verifying their identity, voting in DAOs. Can the infrastructure handle that? Can Ethereum's Layer 2s process a Super Bowl's worth of transactions in real time when a new NFT collection drops? Can Solana maintain its uptime under the strain of a decentralized Uber or a global payment network? The theory is sound, but the practice is brutal. The road to 2026 is paved with potential network crashes, exorbitant gas fee spikes during peak demand, and protocol exploits that we haven't even conceived of yet. Every single part of the tech stack, from the base layer to the wallet on your phone, will be pushed to its absolute breaking point. Overcoming this isn't just about writing better code. It's about building resilient, anti-fragile systems that can withstand the chaotic, unpredictable, and often malicious nature of a truly global, permissionless network. One catastrophic failure of a major Layer 2 could set back public trust by years, reinforcing the narrative that crypto is just a toy for speculators, not the foundation for a new internet. Then there's the third filter, which is more insidious, more of a philosophical battle for the soul of crypto itself. It's the specter of centralization. The irony is that the very success we predict for 2026 is attracting the giants that crypto was designed to render obsolete. The big banks aren't just watching anymore. They're building. They're offering crypto custody, launching tokenized asset platforms, and guess what? They're doing it on private, permission blockchains. They want the efficiency of the technology without the messy, unpredictable, decentralized ethos that gives it its power. And then you have governments. The rise of central bank digital currencies, or CBDCs, is one of the most under-discussed but monumental threats to the crypto ecosystem. A CBDC is not a cryptocurrency. It is the antithesis of one. It is programmable government money. It's a tool that could allow for unprecedented surveillance and control over your financial life. Imagine a world where your digital dollars could be programmed to expire if you don't spend them, or blocked from being used to buy certain goods, or even automatically garnished from your account without due process. This is the dystopian alternative to a decentralized future. The battle of 2026 won't just be between different crypto projects. It will be a three-way war between decentralized public networks, private corporate chains, and state-controlled CBDCs. The outcome of this war will determine whether the Internet of Value is an open, free market arena, or a walled garden of surveillance and control. Finally, the fourth and perhaps most human filter, the user experience. Let's be honest. For all the talk of mass adoption, using crypto is still way too hard. We expect my mom or your uncle to safely manage a 24-word seed phrase when they can barely remember their Netflix password. We expect them to navigate Uniswap, understand impermanent loss, and pay for gas fees without getting scammed by a phishing link or a drainer contract. It's an absurd expectation. The user experience gap between a modern banking app and a self-custodial wallet is not a gap. It's a chasm. For crypto to reach its 2026 potential, it needs its Netscape Navigator moment. That point where the complexity is so perfectly abstracted away that using the technology becomes intuitive, simple, and most importantly, safe. Account abstraction, smart contract wallets, and passwordless sign-ins are all steps in the right direction. But we are not there yet. Every story of a newcomer losing their life savings to a hack or a simple mistake is a powerful anti-marketing campaign that pushes mainstream adoption further away. The industry must solve its user experience and security problem, or it will remain a niche for the technically savvy and the financially brave. So there they are. The four horsemen of the crypto apocalypse. A regulatory reckoning, technological breaking points, the siren song of centralization, and the chasm of user experience. These are not minor hurdles. Each one is a potential extinction-level event for the bullish 2026 thesis. They are the great filters through which the entire industry must pass. Navigating this gauntlet will require more than just brilliant code and clever tokenomics. It will require political savvy, user empathy, and an unwavering commitment to the core principles of decentralization. The question that hangs over everything, the one we will confront in our final part, is not whether these challenges exist, but whether the industry has the maturity, the resources, and the will to overcome them. Because what lies on the other side is not just another bull market. It's the dawn of a new economic reality. So as we look toward the horizon of 2026, we stand at a fork in the road. Down one path lies the fulfillment of a decade-long promise. A world where digital assets are seamlessly woven into the fabric of our daily economic lives. A world where value moves as freely as information, and ownership is verifiable, transparent, and in the hands of the individual. Down the other path lies stagnation. A future where crypto remains a volatile, speculative sideshow, crippled by its own complexity, regulatory battles, and failure to deliver on its core principles. The critical thing to understand is that the outcome is not predetermined. It's not written in the code or the charts. It is being built decision by decision, line of code by line of code right now. The new economic reality we're talking about isn't just Bitcoin at a new all-time high. That's a symptom, not the cause. The real transformation, the one that defines the 2026 outlook, is about integration. It's about crypto graduating from its isolated island and building bridges to the 7 billion person mainland of the global economy. The first and most powerful bridge is the tokenization of real-world assets, or RWAs. For years, this has been a buzzword, but the technology and regulatory clarity are finally catching up. Think about what this means. Imagine a commercial skyscraper in Manhattan. Traditionally, owning a piece of it is reserved for the ultra-wealthy or massive institutions. But when you tokenize it, you can digitally slice that building into a million pieces, each represented by a token on a blockchain. Suddenly, a $20 investment can give you fractional, liquid ownership of prime real estate. Now, expand that concept. Apply it to fine art, private equity, venture capital funds, carbon credits, even a musician's future royalties. This isn't just about making new things to trade. It's about unlocking trillions of dollars in illiquid assets, creating a more efficient and radically more inclusive financial system. By 2026, you won't just be buying crypto. You'll be using crypto to buy the world. The second bridge is the maturation of decentralized finance. DeFi has to move beyond being a casino for crypto insiders. The next evolution, let's call it DeFi 2.0, will be about becoming the invisible plumbing for both the old and new financial worlds. We're talking about institutional-grade lending protocols that major banks feel comfortable using. We're talking about decentralized insurance platforms that can underwrite complex real-world risks, not just smart contract failures. Imagine getting a business loan, not from a bank with weeks of paperwork, but from a global automated liquidity pool in minutes. Imagine your savings account isn't sitting at a bank earning 0.01%, but is productively deployed in audited, insured, and transparent DeFi protocols, with the yield passed directly to you. This is the future where DeFi stops being a weird, separate thing and simply becomes a better, faster, and more transparent way to do finance. And the third, perhaps most important bridge, is the emergence of a true application layer. For crypto to win, it needs a killer app that your mom and dad will use without even knowing they're using a blockchain. This is where areas like decentralized social media or DESO come in. Imagine a social network where you, not the corporation, own your data and your audience, where censorship is impossible and creators are paid directly by their community, not by an algorithm designed to maximize ad revenue. Then there's blockchain gaming. Not the clunky click-to-earn games of the last cycle, but AAA immersive titles where the in-game items, the swords, the spaceships, the land, are actual assets you own and can trade on open markets. And finally, there are the decentralized physical infrastructure networks or DePIN. This is the really mind-bending stuff. Networks of people deploying real-world hardware like Wi-Fi hotspots, solar panels, or environmental sensors, and getting paid in crypto to create a crowdsourced, more efficient alternative to massive centralized corporations. By 2026, the most successful crypto projects might be the ones you don't even think of as crypto. They'll just be better services. So with this complex, chaotic, and exhilarating future ahead of us, how do you navigate it? How do you position yourself for 2026 without getting lost in the noise? It requires a fundamental shift in mindset. I want to give you 3 principles to act as your compass. First, you must abandon a price-only analysis. Obsessing over the daily, hourly, or even weekly price chart in a market this nascent is a recipe for emotional exhaustion and poor decisions. The real signals of future value are not on the price chart. They're on the blockchain. Start looking at metrics that matter. Daily active users, growth in developer activity, total value locked in a protocol transaction volume. Is the network actually being used? Is it attracting talent? Is real economic activity happening on it? In the long run, value always follows utility. Price is a lagging indicator of success. Utility is the leading indicator. Second, learn to follow the narratives but demand to see the fundamentals. Crypto moves in powerful narrative waves. We've seen it with DeFi, with NFTs, with the metaverse, and we're seeing it now with AI and RWAs. It's smart to pay attention to these narratives because they attract capital and talent. But being a successful investor means not just identifying the wave, but finding the sturdiest surfboard. When a narrative like AI crypto takes off, don't just buy the first coin that pumps. Ask the hard questions. Does this project actually use AI in a meaningful way? Or did they just add it to their name? Do they have a unique technology, a real team, a clear business model? A narrative can make a project's price go up for a month. Strong fundamentals can make it last for a decade. And third, you have to brutally, honestly define your time horizon. Are you a trader trying to capture short-term volatility? Or are you an investor positioning for the structural shifts of 2026 and beyond? There is no right answer, but confusing the two is financial suicide. A trader lives and dies by the chart. An investor lives and dies by their thesis. If you believe in the long-term thesis, that blockchain technology will fundamentally rewire our financial and digital worlds, then your job is not to panic when the market drops 20%. Your job is to ask if the fundamental reasons for your investment have changed. More often than not, they haven't. Patience is the ultimate arbitrage in a market obsessed with instant gratification. Conviction, born from deep research, is your shield against the fear and greed that whipsaws everyone else. As we close this deep analysis, it all comes down to one final personal question. Why are you here? What is crypto to you? Is it just a new digital Las Vegas? A place to gamble on memes and hope for a life-changing lottery ticket? If so, the road to 2026 will be a stressful and likely disappointing one. Or do you see something more? Do you see the first strokes of a technological renaissance? A chance to build a more open, fair, and decentralized version of the internet and the financial system? A movement that returns power and ownership to the individual? The outlook for 2026 is not just a forecast. It's an invitation. An invitation to be more than a spectator. It's a call to be a participant, a builder, a researcher, an educated investor who understands the profound shift that's underway. The next 2 years will be volatile. They will be filled with hype, fear, and uncertainty. But for those who can see past the noise, who can focus on the fundamental value being created, and who understand the historic magnitude of this moment, 2026 won't just be another year on the calendar. It will be the year the world finally wakes up to the revolution we saw coming all along.